Welcome to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. We aim to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's video. All opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers.
Hi, I'm John Mark Young. Welcome back to What We Learned in the Markets This Week. Well, here we are, friends, at the end of the second quarter of 2024. April, May, and June is over, and I'm going to run you down a brief recap of what happened this last quarter, while we also take you into our normal roundup of economic data for the week. To take you back to April, we started the quarter off with a market that was dropping, and it was all around the fear of AI companies, artificial intelligence companies that had become too rich in their valuations. Their stock had just maybe gone up too much relative to the earnings that they generated. And we saw most major indexes drop anywhere from 4% to 6% to start the quarter. Not the greatest way to start a 3-month period, but our research firm told us to hold tight when the markets start the year hot, when January through March is really good, and then you have a bad April, you typically see May and June rebound, and that they did, at least for the S&P 500. And within the S&P 500 specifically, tech stocks and utility stocks had a really good quarter, and more on that in a second. As you can see on your screen, the S&P 500, which is our proxy for growth and income, but only when considered together, that was positive for the quarter from April, May, and June. It was positive 4.18%. Not a bad quarter at all, obviously, for the S&P 500. That annualizes out to 16%. However, the Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, that dropped over 6% in April. As you can see on your screen, quite a drop, and then only recovered throughout the rest of the quarter to negative 2.61. So no full recovery for that asset class, aggressive growth. And partly to blame for that asset class lagging recently is the lack of IPOs coming out, bringing new exciting entrants into the Russell 2000, into the small and mid-cap space, aggressive growth space, and the amount of companies with more debt than liquid holdings, or said a more technical way, these companies have very poor liquidity. And finally, the MSCI EFA, which tracks stocks of markets within developed countries across the globe, and that excludes the United States, that was down for the quarter 1.5%. So at least half of our portfolio in Dave Ramsey land, growth and income, that did okay for the quarter. But, and even, the S&P 500, that did okay. It was concentrated. The success was 3 main sectors driving most of the return, utilities and technology being the main. As we discussed, technology and artificial intelligence made a strong comeback in the quarter, as NVIDIA even touched a $3 trillion valuation throughout the quarters. And utilities did really well. Now, why did utility stocks do so well throughout the quarter? That's baffling, right? Because those are supposed to be slow growers. Maybe they do well in bad markets. But because the utility stocks are benefiting from the AI play. Now, how are they benefiting from the AI play? Well, to create the massive amount of computing power that is needed for artificial intelligence, we are in desperate need of data centers to create that and hold that information and that technology. A company called QTS, which is the largest operator of data centers in the U.S., who our own Summit Puri, our lead market research analyst, he was able to tour one of their beautiful facilities in Arizona a few months back. And somebody will tell you, as they will, they cannot build these data centers fast enough. And partly the supply chain for these data centers are power grids that make all this computing possible. So utilities are on a bit of a tear right now, up over 5% for the quarter, just because they have to supply. We need more electricity to supply these data centers. And one might ask, how can I invest in data centers? How can I get diversification within AI and the data centers? Well, most people probably have NVIDIA already. So you have the semiconductor chip of AI. But data centers as results in real estate, that is a great theme that we think you could and should invest in. We only know one company that can do that. And you can ask your financial advisor for more information about how to be part of the AI data center play if you'd like to with your investment portfolio. But all that to say that those two sectors led the market forward in May and June, and that led the S&P 500 to a positive result, which was, again, half of our portfolio having a positive result in a Dave Ramsey land. With all that, let's dive into our weekly roundup of economic data. And first, each week, we review the Atlanta Fed's GDP Now report to gauge in real time how fast our economy is growing. Now, we're at the end of the quarter, so now it's just getting past the last pieces of data entered into the algorithm. And at this point, the numbers start to become very, very accurate. They have a low probability of error to the real number. As we learned last quarter, where we had a pretty nice sized dispersion between what the Atlanta Fed thought the number was going to be and when the actual number came out, it's not always 100% accurate, but most quarters, the closer you are to the end of the quarter and the actual report, the more accurate the number actually is. Now, this week, the Atlanta Fed's number came in at 2.2%, which was a significant drop from the 3% we saw last week. Private domestic investment growth GDP dropped, and that was what brought this number, part of what brought this number lower for the week. Next, each week, we look at the initial claims for unemployment insurance for a gauge into the front end, and if there's problems on the front end of the labor market. The Fed gets this report, as each and every one of us do, each and every week, so they can have high-frequency data as it relates to employment. This week, the number came in at 233,000 initial claims for unemployment insurance, which is right in line with the one-year average. Next, for the year of 2024, we're touching on mortgage rates to see how home affordability is doing. We know that prices are continuing to, at minimum, stay level, at a high level, thanks to data discussed last week from Summit Puri, our research guy. However, this week's rate stayed almost neutral, coming in at 6.86 on the 30-year mortgage and 6.16 on the 15-year mortgage. And finally, we saw how the markets did on the quarter, but let's check on how they did for the week as we look at each and every week. So this week, the S&P 500, which is our proxy for growth and income, but only when considered together, that was negative. It ended the week negative, even though it had a positive quarter, negative 0.33. The Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, that was positive for the week, 1.27%. And the MSCI EFA, which tracks international stocks of developed countries across the globe, excluding the U.S., that was positive 0.49. So aggressive growth on top for the week to end the quarter. How about point number two? Speaking of GDP, as we do in each point number one with the Atlanta Fed, the quarterly GDP number for quarter one, and remember that is January through March, that does get a couple of rounds of revisions before actually being finalized by the Bureau of Economic Analysis, the BEA. And they released their third estimate of U.S. GDP, gross domestic product, for the first quarter of 2024 this last week, and they reported a revision to the upside, a growth rate of 1.4% now. Now, this was an upward revision from the second estimate, which was 1.3, and this was primarily attributed to a downward revision in imports and upward revisions in non-residential fixed investment and government spending, partially offset by a downward revision in consumer spending, which is 2/3 of the economy. Current dollar GDP, reflecting the total value of goods and services produced in the U.S., it increased by 4.5% annually, and that reached a number, $28.27 trillion in quarter one of 2024. This upward revision of $13.2 billion from the previous estimate was accompanied by an increase in the price index for gross domestic purchases, which rose by 3.1% in quarter one 2024. Similarly, the personal consumption expenditures, the PCE price index, a measure of inflation, that increased by 3.4 during that same period of time. How about point number three? The S&P 500, it tracks prices of the top 500 profitable companies in the United States. However, there is an index, also done by S&P, that tracks home prices, and it was released this last week. The S&P CoreLogic Case-Shiller Index showed an upward trend in home prices for April of 2024. Now, this is a lagging indicator, meaning we get it late, so it's not anything you can base future on, but it has deaccelerated for 2 consecutive months. But the index now reported a 6.3% annual gain, a decrease from the previous month's 6.5% gain. Despite the slowing growth, the national index has seen an increase of at least 1% over its previous all-time high for now 2 consecutive months. April of 2024 closely mirrored the trends of the previous year, which is where we saw March and April experience the largest price increases before slowing down throughout the rest of the year. Now, what parts of the country did well? Well, the Northeast region has demonstrated the strongest price growth, surpassing other regions for the past 9 months, a trend that they haven't seen, or we haven't seen in that area since 2011. San Diego has consistently led the price increases, achieving double-digit growth and holding the top spot for annual returns over the past 6 months. So if you live in San Diego, you're doing pretty well in terms of home prices. If you're trying to buy a house there, tough. In contrast, Denver and Portland have experienced the slowest growth rates nationally. As we discussed in previous weeks, the Federal Reserve's efforts to curb inflation, including raising interest rates, have impacted mortgage rates. As a result, mortgage rates have risen, to a 23-year high of around 8% in October of this year, and as we looked at earlier, continued to decline. While rates have decreased since then, they remain higher than average, 6.8 on the 30 years we talked about, 6.16 on a 15-year. Now, these high mortgage rates, and their influence, not completely set, but influenced by the Federal Reserve's actions, have impacted the housing market by making homes less affordable and contributing to our housing shortage. Thus, housing may be a good place to invest. And finally, point number 4. The number we were all waiting for this week, at least the economic folks, was the PCE number for May. Now remember, we love PCE as a gauge for inflation much better than CPI because PCE is actually what you buy instead of just a broad basket of goods. And here's what we learned with this week's report. U.S. prices remain stagnant in May of 2024. That's good in terms of inflation, stagnation, offering a respite to inflation and potentially influencing the Federal Reserve's interest rate policies into the future. The Personal Consumption Expenditures Price Index, PCE, again, is a crucial gauge that the Federal Reserve uses. And with it remaining unchanged in April, that marks the first time that's happened since November of last year, 2023, that we had no price increase, no inflation month over month for what you actually buy. This stagflation in prices was largely attributed to a decline in energy prices, which fell by 2.1% for the month. The core PCE price index, which excludes volatile food and energy, also showed a minimal increase of only 0.1%, further indicating easing inflationary pressures. Now, consumer behaviors in May of 2024 reflected a sense of caution rather than a complete pullback in spending. So we pulled it back, just not crazy pullbacks, despite rising interest rates and persistent inflation. Consumer spending has been a key driver of economic activity for the last few years, and that increased by 0.2% for the month. This increase was observed across various sectors of spending, including recreational goods and non-durable goods like clothing. And while spending on the services side of our sector, we have two sides, goods and services, but services, it saw its slowest pace in 10 months. Consumers continued to spend mainly on transportation and recreation. The overall economic outlook, influenced by slowing inflation and moderate consumer spending, suggests a period of adjustment rather than the hard landing, the recession that was called for later last year or earlier last year. There are several factors that are contributing to this cautious consumer behavior, including inflation fatigue, elevated borrowing costs, and a moderation in wage gains. However, the increase in personal income and disposable income in May, based on this report, coupled with a rise in the personal savings rates, which was interesting, indicated that there is some resilience in household finances. Maybe more people are watching Dave Ramsey. This also suggests that while consumers are being more prudent, they are not entirely tapped out, offering a glimmer of optimism for continued economic activity through the rest of the year. Now, this decline in inflation, coupled with moderate consumer spending growth, suggests a potential shift in the Federal Reserve's monetary policy. The Fed had expressed the need for continued strong and hard data to warrant a rate cut later in this year. Well, in our view, the Fed, having implemented significant rate hikes since 2022, pulling us up to about 5% interest rates, now they might be inclined to start cutting interest rates with a few of these inflation reads that have been a little bit lower and or flat. And that might happen as early as September of 2024, according to CME Group and our thoughts. This is based on the expectation that the current trend of slowing inflation will persist over the next few months, providing the Fed with significant confidence to adjust its monetary policy. And that's why watching the CPI and mainly the PCE numbers are so important to determining what's going to happen with interest rates. Because if those numbers come in too hot, we could be sticking with higher for longer. But at this point, it feels and seems Like inflation has been cut. The last hard pieces of it, housing and auto insurance, as we discussed in previous videos, those were lagging indicators that we figured would come down. They're starting to come down. And thus having inflation or a PCE number, a non-core PCE number that came in at 0, that means there's no inflation. Now, I know a lot of people find that hard to believe. No inflation. But that's not to say inflation didn't happen. We had a lot of inflation. It's to say it's not continuing to grow. And that's the key with inflation. You can't go back. You can't go into disinflation. That's not going to happen. It very rarely does. And when it does happen, it actually is a really bad sign for your economy. You just have to hope that you don't continue to have inflation. The stick of gum is still going to cost a whole lot more. That trip to Walmart is not going to be $2.50 anymore. It's going to be $4.15. But that's okay. That is what it is. You got pay raises to deal with that, hopefully, especially if you switch jobs. So now you just have to live and hope that there's no more high 9%, 10% inflation like we had in the 70s where we killed it and then it came right back. That's why watching those reports like we do and like we think you should, that's why we deliver these videos to you, are so important to helping determine your financial success, as well as you just continue to execute the baby steps, control what you can control. With that being said, if you would like to meet with any of our financial coaches who help you in baby steps 1, 2, and 3, or our financial planners and advisors who help you in baby steps 4, 5, 6, and help you get to baby step 7 where you can live and give like no one else, go to the comment section of this video where you can click the link, as well as you can hit the like and the subscribe button, and that actually helps us. It helps us push our content out to more people, and it helps us with YouTube and Google's algorithms. So thank you so much for doing that, and we'll look forward to seeing you next week.